What if I told you there's a 90% chance you're making one of the biggest money mistakes? Even if you think you're investing smart, you've heard invest early, invest often. But there's a secret twist almost nobody tells you, and it could cost you tens of thousands of dollars over your lifetime. Stay with me, because you'll learn exactly what the invisible leak in your finances is and how to fix it before it's too late. You might think your finances are secure, but here's the truth. Most people lose money silently without knowing it. In this video, I'm going to expose 3 hidden money leaks that are quietly devouring your returns, nearly guaranteed to erode your wealth. And I'll also show you how to stop the leak, turn it into profit, and accelerate your wealth, starting now. Welcome back. If you want to build real sustainable wealth, not just get lucky, understanding where your money leaks is more important than chasing the next shiny investment. Over the years, I've seen many smart people pour money into ETFs, stocks, and funds, yet quietly bleed returns through mistakes they never addressed. In this video, we'll break down 1. The leak you don't see. 2. Smart investing behaviors you must adopt. 3. Advanced accelerators. Plus, we'll walk through a real transformation story, and I'll leave you with a clear action plan you can implement immediately. Let's start by exposing that first hidden leak. Leak number 1 is the opportunity cost leak. Money that's sitting idle or underutilized while it could be working harder. Let me explain. Let's say you leave $10,000 in a standard savings account earning 0.5% interest. Inflation at 3% eats away the value. That unused capital is effectively losing you money every year. Worse, that capital could have been invested in a low-cost index fund, producing 7 to 10% annual returns. Over a decade, that difference compounds in a huge way. Many people also hold cash reserve sizes far larger than necessary, or keep money in underperforming accounts, low-yield CDs, outdated accounts, forgotten IRAs. Here's the trick. Define a working capital buffer. Only keep enough cash for emergencies and near-term goals. Everything else should be making you more money. Action tip number 1. Run a cash audit. List every account, its current yield, and whether it's performing better invested elsewhere. Warning: don't completely eliminate all liquidity. Keep a safe emergency fund, 3 to 6 months, but don't let excess capital sit stagnant. One more nuance: money sitting in non-tax advantaged accounts might face capital gains or interest income tax. That's another dimension we'll explore soon. Okay, now that we've exposed the first leak, let's plug it by developing the right behaviors and habits. These are foundational, and without them, you'll always underperform. Behavior number 1. Dollar cost averaging and automation. Set up automated contributions, weekly or monthly, into your investment accounts. You remove timing risk, force discipline, and smooth out volatility. Behavior number 2. Diversification plus core plus satellites. Build a core allocation in broad indexes. For example, S&P 500, total market, total bond, and a satellite slice for higher growth or tactical bets, small cap, sector, real assets. Behavior number 3. Low fees, tax awareness, and rebalancing. High fees are one of the silent killers of returns. Use low-cost ETFs and index funds. Keep an eye on expense ratios, and rebalance periodically to maintain your targets. Behavior number 4. Continual education and review. Markets shift, tax rules change. What's optimal today might not be in 10 years. Schedule an annual financial tune-up to revisit your plan, goals, and leak points. Behavior number 5. Avoid emotional investing and timing traps. Fear and greed kill returns. Don't chase trending fads or abandon your plan during crashes. Practice patience and stick to your plan. Let's move to the advanced side, where real wealth acceleration happens. Now, for those ready to go beyond basics, here's where you can accelerate your returns, but with more responsibility and care. Accelerator 1. Using leverage responsibly. Leverage can amplify returns, for example in real estate or margin investing. But it also amplifies losses. The key is smart, controlled use. Small leverage on high conviction bets, with enough padding to survive drawdowns. Accelerator 2. Tax optimization / tax advantaged accounts. Max out 401k, IRA, SA and exploit any tax credits or deductions. Favor accounts where gains are deferred or tax-free. Also consider tax loss harvesting, buy and hold strategies to minimize trading turnover, and asset location, putting bonds in tax-sheltered accounts, equities in taxable, etc. Accelerator 3. Strategic real estate and alternative assets. A slice of real estate, REITs, rentals, or alternatives, private equity, crowdfunding, etc., can add uncorrelated returns, diversification, and tax benefits. Depreciation. Accelerator 4. Side hustles and capital reinjection. Investing isn't just about returns, it's about capital. By building additional income streams, side business, freelancing, royalties, you increase the base you can redeploy. Accelerator 5. Leverage your own skills/intellectual capital. Invest in yourself. Courses, skills, relationships. The returns on human capital often dwarf financial returns, especially in early years. Now let me show you a real-life case study of someone who used these techniques to go from modest savings to real wealth. Let's talk about Jane. In 2015, Jane had $10,000 in savings and a steady 9-to-5 job. She felt on track, but her money was mostly in low-yield cash accounts. She decided to run a self-audit using a money leak detector. She discovered $5,000 in idle cash, high-fee mutual funds she'd inherited, no tax strategy or side income. Over the next 7 years, here's what she did. 1. Moved excess cash into a diversified low-cost index portfolio. 2. Automated contributions and rebalanced quarterly. 3. Opened a Roth IRA plus HSA, maxing contributions. 4. Bought a small duplex using leverage, 10% down, and rented half of it. 5. Freelanced on weekends, adding $5,000 per year extra to her investment base. By 2022, her net investment plus real estate portfolio was $300,000. Total ROI from active capital, approximately 15% annualized overall. And most importantly, she now understood the leaks and controls them. Her story shows that the difference between knowing and doing is practice, discipline, and plugging leaks early. Now, I'm sure some red flags or questions popped into your head. Let me address common objections head on. Objection 1. What if I lose money? I'm afraid of risk. Answer. Risk is real, but risk is also managed. With diversification, proper sizing, and emergency buffers, you can greatly reduce downside. Objection 2. I don't have time to manage all this. Answer. That's why automation, scheduled reviews, and low-maintenance strategies exist. You don't need to be constantly active, you need to be consistent. Objection 3. I'm too late, the market is overpriced. Answer. Nobody times perfectly. Focus on your time in the market, not timing the market. Even if valuations are high, disciplined investing still wins over time. Objection 4. I don't have much capital to start. Answer. Start small. Even $50 or $100 per month, consistently invested, compounds over decades. The mindset and habit matter more early on. Objection 5. Taxes, fees, complexity, too overwhelming. Answer. Yes, they add complexity. But that's exactly why you audit, simplify, outsource, and plug leaks. You don't have to do everything at once. Just start with the biggest leaks. The key is, don't let perfection be the enemy of progress. Let's now move into your action plan. Here's your actionable plan, adapted to your life, to go from awareness to real results. Phase 1. 30-day money leak audit. Day 1 to 3. List all accounts, yields, and idle cash balances. Day 4 to 7. Move excess idle cash to higher yield or investable accounts. Day 8 to 14. Rebalance and eliminate high fee funds. Day 15 to 21. Automate new contributions or transfers. Day 22 to 30. Set up calendar reminder for quarterly reviews and schedule the tune-up. Phase 2. 12-month growth roadmap. Months 1 to 3. Fully fund tax-advantaged accounts. 401k, IRA, HSA. Months 4 to 6. Explore a small real estate or rental property or add alternative asset exposure. Months 7 to 9. Ramp up side income. Freelancing, consulting, digital products. Months 10 to 12. Reevaluate your plan, adjust allocations, and project forward. If you follow this roadmap even roughly, you'll plug most of the hidden leaks and set your money to compound strongly.